Among my very highest priorities is to rescue our economy and get dramatic and immediate relief to working families. As you know, we inherited from the last administration an economic catastrophe and an inflation nightmare. As president, I'm fighting every day to reverse this damage and make America affordable again. Other countries have used tariffs against us for decades, and now it's our turn to start using them against those other countries. Tariffs are about making America rich again and making America great again, and it's happening, and it will happen rather quickly. There'll be a little disturbance, but
Commerce Secretary Howard Lutnick offering some relief maybe to markets this morning, saying that President Trump will, quote, probably reduce tariffs on Mexico and Canada later on this afternoon. We're seeing some of that reflected in the pre-market action here this morning. Joining us now, we want to bring in Jason Furman. He's a professor at the Harvard Kennedy School of Government, also a former Council of Economic Advisors chairman under President Obama. Jason, it's great to have you back here on Yahoo Finance. I guess let's just start with the whipsaw action, I think it's fair to say, out of Washington here over the last couple of days. Just what's your assessment of some of these tariffs that have been announced, and then the threat of reciprocal tariffs as you look ahead to next month?
Yeah, it's just really extraordinary. I mean, the one fixed point for Donald Trump is he loves tariffs. The reasons he loves them keep changing. The countries change. The magnitude of them change. But those love of tariffs, that's the one thing that there's no whipsawing on. It keeps being the same.
What do you see as the economic consequences of these tariffs? And obviously there's so much unknown at this point, just in terms of what they're going to look like, whether or not we're going to see any sort of reduction in the tariffs that have been announced on Canada and Mexico. But how big of a threat is it to the U.S. economy?
It depends on the magnitude of the tariffs and their duration. The impact is definitely negative. There's no doubt about that. More inflation makes it harder for our exporters, so harder to add jobs, bad for growth. All of that goes in the same direction. How big it is depends on how much. Canada and Mexico, even a 10% tariff across the board that was sustained would be very disruptive to one of the most successful integrated markets in the world.
Is there a threat of a recession there, Jason?
I don't think for the United States. For Canada, there might be, by the way. And one thing the president's right about is there is some asymmetry here. The United States matters more to Canada than Canada does to the United States. So for us, you're talking about slower growth. And then we'll see how the Fed responds. If you get more inflation, do they say we need to raise rates or hold off on rate cuts? Or do they get nervous enough about the real economy that they cut rates? And, last time around with the big tariffs in 2018, 2019, they cut rates. This time, I don't think they're going to be so quick to rescue the economy.
Jason, what's the biggest lesson that you're taking away here from the last several days, and really what we've seen over the first month and a half of the Trump administration, just in terms of the approach right now to global trade and the follow through that we've seen on some of the tariffs? Look,
the president's economic advisors are not in charge. They had very different ideas. The stock market is not in charge. The president's not talking about it anymore. In fact, he's talking about the bond market, where yields are falling largely because the economy is slowing and nervous investors are fleeing to safety. So the person who's in charge right now is Donald Trump. He's making these decisions, and his whims change from moment to moment. But those whims are really about the details. The fundamentals are staying the same, and it's disengagement of the United States from the global economy.
Jason, let's talk a little bit more about just the market and comparing that to the weakening economy that we are seeing. Yes, we have seen a bit of a pullback here in stocks as of late, but we're not too far from those record highs that we hit not too long ago. I guess, how do you reconcile the market still at the levels that it's currently at, comparing that to the threats coming out of D.C., tariffs that have been introduced, and then coupling that with the weakening econ data that we have been getting?
Yeah, first of all, the market is down from its post-election highs. Second of all, there's other things that matter to the market, like developments in AI. If you think there's things that are going to increase the share of profits going to businesses, for example, more lax regulation, that can also help the market in certain sectors. And finally, they're betting on a lot of these tariffs being dropped. I'm less sure of that.
Jason, how do you think the Fed is looking at this? And you brought that up a moment ago, just in terms of what is exactly how they're looking at the weakening data, maybe how they're looking at tariffs specifically. I guess, do you think it makes it more likely that they're going to act sooner rather than later? And then what does that mean just for the ongoing or potential for multiple cuts here between now and year end?
So there's two conflicting forces here. Higher prices mean you want to raise interest rates. A slower economy means you want to cut interest rates. There's a lot of uncertainty about how much this is a one-time change in the price level versus a change in inflation. I'm not entirely sure what the Fed would do, but at the very least, that level of uncertainty raises the bar on their acting. It makes it the evidentiary threshold to cut interest rates that much higher. And I think that evidentiary threshold is going to be something like the unemployment rate rising to 4.5% before any more interest rate cuts are in play.
Jason, is that the most important economic indicator to watch? Or I guess what is when we're trying to assess the threat here or the likelihood of an economic downturn?
You want to look at a lot of data, but certainly the unemployment rate, what we're seeing in terms of job growth, those are two of the most timely and accurate measures of the economy. There was GDP now from the Atlanta Fed is showing negative growth. I would discount that quite heavily. I think there's some real flaws in their methodology. So I don't think the economy is turning on a dime in a negative direction, but everything, the uncertainty, sentiment, all of that is pushing towards slowing.
All right, Jason, always great to get your insight. Thanks so much for taking the time to join us.
Thanks for having me.